Right, let's dive right into this explainer and build a crystal clear, step-by-step understanding of Section 21. Now, as tax professionals and students, you already know that Section 20 is the basic charging provision. It is what brings income from house property into the tax net. But Section 21? Well, Section 21 is the actual machinery. It's the engine where we calculate the real numbers. So let's decode the statutory waterfall together, shall we?
Okay, before we even touch a calculator, we absolutely must define what we're actually looking for: annual value. This is exactly what the entire mechanism of Section 21 is trying to determine. In simple terms, it's the inherent earning capacity of a property. You see, the law isn't just looking at the cash you physically put in your pocket, it is looking at what the property is genuinely capable of generating. Keep this concept of earning capacity right at the front of your mind, because honestly, it explains the logic behind almost every single rule we're about to cover.
We are going to tackle this entire section in 5 straightforward steps: the basic rule of letouts, adjusting for vacancy, taxes and unrealized rent, builders and stock in trade, and finally, self-occupied house properties.
Let's start right at the top of the funnel. Step 1. The basic rule of letouts under Section 21, subsection 1. Now, the law uses this really fascinating comparative logic right out of the gate. It constantly weighs what you could earn against what you actually earn. On one side, we've got expected rent. The statute defines this as the sum for which the property might reasonably be expected to let from year to year. So it's purely a notional figure. On the exact opposite side, we have your actual rent, the rent received or receivable by the owner, provided the property or even a part of it is actually let out.
So what's the crucial takeaway here? The taxman always takes the higher of these two figures. This is literally the starting checkpoint for all your computations. And you might wonder, why? Well, the law wants to completely block tax avoidance where an owner might just show an artificially low actual rent on paper to save on taxes. By comparing it to a reasonable expected rent and mandating we take the higher amount, Section 111 sets a very firm, unavoidable baseline.
But hey, real estate is never perfect, right? So let's move to step 2, adjusting for vacancy under Section 21(2). We need to see what happens when a property just sits empty.
Picture this scenario. You've got a fantastic property, but your tenant leaves and the place is vacant for, say, 3 months out of the tax year. Now, under that strict basic rule we just talked about, your expected rent for the whole year might suddenly be much higher than your actual rent, which you only received for 9 months. Would it be fair for the assessing officer to tax you on the higher notional rent when you genuinely had no tenant? Obviously not. And that is exactly where Section 21(2) steps in to give you some relief. This table perfectly breaks down the required cause and effect. If your actual rent dips below the expected rent, specifically because of the vacancy, the law kindly lets you use that lower actual figure as your annual value. But, and this is a big but, if your actual rent somehow stays higher despite the vacancy, you have to stick with the actual rent. It is a highly logical, purely cause and effect provision.
All right, step 3, taxes and unrealized rent under Sections 21(3) and 21(4). Let's see how practical, real-world deductions further alter our baseline.
Now, you've got to pay very close attention to these strict conditions in Section 21(3). The annual value shall be reduced by taxes levied by a local authority, think municipal taxes, which explicitly includes service taxes. But look at that phrasing on the screen, actually paid during the tax year by the owner. This is absolutely massive for your computations. It operates strictly on a cash basis. It doesn't matter one bit when those taxes became payable. If you didn't pay them this year, you don't get the deduction, period. And furthermore, they must be paid by the assessee, the owner. If your tenant pays those municipal taxes, the owner cannot claim this reduction.
Similarly, what if a tenant simply defaults? Just flat out refuses to pay? Well, Section 21(4) ensures that this phantom income, rent which you literally cannot realize, is completely excluded from your actual rent computations. You shouldn't have to pay tax on money you genuinely cannot recover. But of course, the statute clearly notes this is subject to specific rules made in this behalf. That means you have to definitively prove it's a genuine bad debt, not just some casual friendly arrangement to waive the rent.
Moving right along to step 4, builders and stock in trade under Section 21(5). Now we are taking an alternate path specifically designed for real estate developers.
That giant number 2, that represents a critical 2-year grace period granted to the real estate sector. But be careful, the clock doesn't just start ticking immediately. It is calculated specifically from the end of the financial year in which the completion certificate is obtained from the competent authority. Let's look at how this applies in practice.
This essentially acts as a protective shield for developers. Under Section 21(5), if a property is held as stock in trade, meaning its inventory meant for sale, and it is not let out at any time during the tax year, its annual value is deemed to be strictly nil. But it's not forever. It only applies for up to 2 years from the end of the financial year of completion. This gives builders a very reasonable window to sell their flats without being completely crushed by taxes on notional rent. And for the tax aspirants out there, definitely note the recent amendment by Act No. 4 of 2026, effective April 1st, 2026, which solidified this exact phrasing.
Finally, we reach the bottom of the funnel, Step 5. Self-occupied house properties under Sections 21(6) and 21(7). How exactly does the Income Tax Act treat the roof over your own head?
Section 21(6) is honestly one of the most heavily used provisions by individual taxpayers. It plainly states that the annual value of a house property is taken as nil if the owner actually occupies it for his own residence. But interestingly, it also extends to situations where the owner cannot actually occupy it due to any reason. So, if you are employed in another city and have to live in a rented place there, the baseline annual value for your self-occupied property back home is completely zero.
But hold on. We are seeing the number 2 pop up again. And this is a very critical checkpoint imposed by Section 21(7)(a). You see, you can't just claim that you self-occupy 10 different mansions and walk away paying zero tax. Section 21(7) specifically restricts this generous nil value to a maximum of only 2 houses, and these must be specifically chosen by the SSE. Furthermore, this benefit is incredibly fragile. Clause B lays it out. If the house is actually let out during any time of the tax year, even just for a few days, or if you derive any other commercial benefit from it, that beautiful nil value vanishes immediately. And just like that, you get thrown right back up to the basic computation rules in Section 21(1). So master the statutory flow, from expected rent all the way down to those strict self-occupied limits, and you will never stumble on a house property computation again. You'll navigate the 2025 Act with total confidence. But here's the real question I want to leave you with. In a landscape where property owners constantly try to mask commercial benefits just to claim that nil value, how exactly do you think the tax department will use these exact provisions to unravel those structures during a tax audit? Keep that in mind the next time you sit down to look at a property tax computation.